Mark, I want to get your perspective on what's been going on in August. We're talking about protection against volatility. The market has been very volatile in August. How did you react to the big drop on August 5th? You're a financial advisor. There's money under management
I went for a walk on the
with
beach.
your company. Well, you know, and that report on August 5th, by the way, the events of August 5th followed that disappointing July jobs report, and there was a big run-up in the yen that day. I know some said it was a mini flash crash. How should we view what happened? You referenced it briefly, but how should we view what happened? A week ago?
Yeah, I mean, it struck me at the time as a flash crash, and it was actually a pretty small one. I mean, if you go back to October 19th, 1987, I mean, it dropped, I think it was about 22% in a single day. But, I write about this in the book. Flash crashes are kind of like the rogue waves of Wall Street. It happens when you have a bunch of different market forces kind of coming together at the same time. That's what happened in 1987. And there were a bunch of complex forces, economic and technical as well, with portfolio insurance, but they all converged at the same time, and you get these outsized movements in the market. And the one that occurred on August 5th, it seemed like that. So you had the activities in Japan with the Bank of Japan raising rates and the collapse of the Japanese stock market. You also had in the United States, it wasn't a horrible, but a relatively weak employment report, coupled with the triggering of kind of the latest faddish metric, the SOM rule. So you had all these forces colliding. It created an outsized movement, and you never know how deep it's going to go. You never know how long it's going to last, but you are better off doing nothing in these events. And now, if your portfolio is out of balance, there could be an opportunity to rebalance and actually generate value. But it just seemed like a rogue wave, and you get these get these periodically, and you just gotta keep your wits about you.
So I just want you to summarize this. What's the best reaction to volatility? What does investing history tell you investors should do? It seems like you're saying, by and large, if you have a plan and a long-term investing plan, you should do nothing in reaction to a sudden flash crash. It seems that's
correct,
what you're saying.
and possibly rebalance. If you have a portfolio and you breach certain limits, it's actually a great opportunity to rebalance. There's actually a great story about David Swensen, who's very well recognized as one of the best institutional investors ever. He was the late CIO at the Yale University Endowment, and he used to actually trade on days like this. He had a little trading desk where he would trade treasuries and rebalance the portfolio. So if anything, it's an opportunity. I'm not saying people should do that, but at minimum, just the worst thing you can do is trade out of fear and sell risk assets when you have one of these crashes. They do resolve eventually. You can't predict when, but you're just better off doing nothing.
Better. So the bottom line here is have a plan and stick to it, whether you're buying protection or you're buying buffered products or you're staying with the S&P 500, stick with the plan. Don't do anything in a panicky way. Very interesting discussion, folks. We've been talking about volatility and how to handle volatility. And here are two experts in the field with slightly different approaches to it, but still very important for you to understand the history of markets and how they've reacted to these sudden big moves here.